So let's get some more analysis from Bob Parker, Senior Advisor at Credit Suisse. Bob, thanks very much for coming. Good to see you again. So, I mean, what do you make of all of this? Because the airlines, of course, still feeling the effects of almost $2 billion of losses from Iceland's volcanic ash cloud, and now the threat of more industrial action presumably is going to impact on their earnings.
Well, we have not been investors in the airline industry for many, many years. And as your report has shown, the airline industry has been hit by problem after problem. Obviously, there is significant variability between the airlines, between the low-cost carriers and still the problems at the high-cost carriers who are having to deal with very high labour cost problems. And arguably what's going on here with this potential strike is yet another example of the airline industry and the airports having to adjust to a lower cost base.
So tell me, Bob, we are, just 15 minutes away from the start of the trading day here in Europe. What are you going to be focusing on this week?
I think after the falls in equity markets last week, you have to ask the question, are we going to have a technical recovery this week? I think that's probably going to be a struggle. We've had poor economic data out of Japan announced earlier today, much worse than market expectations. I think in the US, the corporate earnings numbers coming out of the retail sector are probably going to be in line or worse than market expectations. So after that very good equity market performance in July and early August, I'm assuming that the next 2 to 3 weeks, the downside risk is now fairly limited because valuations are now very cheap, dividend yields are high, there's a lot of cash sitting on the sidelines, but I think at best equity markets are going to trade sideways.
So, Bob, where do you see the best investment opportunities right now?
Well, in terms of strategy, we are continuing to run our position in emerging debt. We're continuing to run our position in corporate bonds. We also have a small position in high-yield bonds. That's on the fixed income side. On the equity side, we are currently being defensive. Having said that, we're pushing money on market setbacks into emerging equity markets, and within emerging equity markets, I would just highlight the underperformance of China versus markets like India. China now, I think, is actually a buy. It is looking compellingly cheap. There is a lot of domestic cash sitting on the sidelines, which has come out of the Chinese real estate market.
Bob, as you say, we've had disappointing GDP data from Japan, also disappointing eco data from the US, and indications that the Chinese economy is slowing down as well. How do you assess the risk of a double dip in the global economy?
Well, I think just to put your comment on China into perspective, yes, China is slowing down, but it's slowing down from 13% growth to probably somewhere between 8 and 10% growth. The Japanese numbers were much worse than the Bloomberg consensus. The Bloomberg consensus was an annualized growth rate of 2.3. It came out annualized at 0.4%. Given the yen close to 85, actually, I think it's quite difficult to see that export-led recovery in Japan continue. And after very good data...
Okay, Bob Parker, thanks very much.